Hello. Since you are here today, you are probably looking for a clear signal amidst the chaotic noise of the markets. Perhaps you feel lost when looking at the charts, or maybe you keep asking yourself, what is the secret to this? Today, we are going to dissect a name that has become a legend in the trading world, not just for the money he made, but for the method he used to make it, Steven Dux. Do you know why it is important to talk about Dux? Because his story isn't actually about millions of dollars made in the stock market. His story is one of obsessive patience, measurable discipline, a fanatical habit of record-keeping, and most importantly, the great war one wages against their own psychology. Now, sit back. I want to take you back a bit to where this story began. I want you to think. Imagine a young student who came from China to the United States to study engineering. His English isn't perfect, his circle isn't wide. But in his pocket, he has a dream and a capital of about $27,000. While this money could have been a security for his education and future, he decides to throw it into a risky sea, the ocean of the stock market. And the result? In just a few years, that $27,000 turns into a fortune of millions of dollars. Sounds like a movie script or a classic get-rich-quick fairy tale, doesn't it? But what distinguishes Steven Dux from the others is that he didn't win this fortune by luck or a lottery hit overnight. He built it like an engineer building a bridge, brick by brick, data by data. In this episode, we will focus not on what Steven Dux did, but on how he thinks. We will get inside his mind. Steven Dux's background is actually the key to his success. He was an engineering student. So how does an engineer look at the market? When a normal investor looks at the screen, they see red and green candles, prices going up and down. An engineer sees variables. Why did it rise? At what time did it rise? How was the volume? What was the news flow? When Dux first entered the market, he got slapped just like everyone else. He lost money on his first trades, he pushed his account too hard, failed to manage risk, and faced those painful dangers of blowing up the account. Most people at this point get offended by the market, say, the stock market is gambling, and walk away. But Dux didn't leave. His engineering training whispered to him, if a system is giving an error, there is a wrong data entry somewhere. Find the problem and solve it. Thus, Dux entered perhaps the most critical period of his trading career, the data collection era. For months, he worked an average of 10 to 12 hours a day. But this work wasn't just staring at the screen. He practically set up a small laboratory for himself. He examined thousands of stocks one by one. He performed backtesting on historical charts. What he did was this. He opened Excel spreadsheets and started noting down everything he saw. At what time did this stock rise? How many minutes after the news broke did the movement start? At what volume increase did the price reverse? What makes Steven Dux the person we know today are those boring analyses he did in that dark room while no one was watching. In that laboratory, he realized this. The market was not a chaotic environment moving randomly. Yes, it was complex, but behind it lay human behavior. And throughout history, humans have always given the same reactions: fear, greed, and panic. Dux transformed these emotional reactions into mathematical data, that is, into setups. There is a single concept at the center of his success: control. No matter how much you win in the market, if you lose control, that gain is not permanent. The market loves to take back what it gives. Dux learned this very early and painfully. He saw that his biggest problem was not the strategy, but himself. Especially that famous FOMO, fear of missing out. You know that feeling that gnaws at you while a stock is skyrocketing? Oh no, it's getting away, I must buy immediately. That feeling is a trader's biggest killer. Dux didn't try to suppress this emotion. Like an engineer, he started to measure his emotions too. He noted down in which mood he made mistakes. Does he lose more when he is sleep-deprived? Does he make mistakes out of overconfidence after consecutive winning days? And over time, he developed rules with very strict military discipline. For example, if I lose in a trade, I cut my position size in half for that day or for my next trade. Think about this. What do most people do when they lose? They play bigger to recover the loss, right? They do revenge trading. Dux does the exact opposite. If he lost, he says, it means my sync with the market is broken, I must hit the brakes. And he shrinks his risk. Or he withdraws that money from his account after a big win. Why? Because seeing a huge balance in your account gives you the feeling, I am the king of the markets, I am invincible. This false confidence brings disaster. Let's remember that famous quote by Steven Dux. Your most dangerous opponent is not the price on the screen, it is you in front of the screen. So, what does Steven Dux do technically? Let's get into the kitchen, into his strategies a bit. Dux specializes in what we call penny stocks, usually very volatile stocks with small market caps. He doesn't use complex indicators that fill the screen. What he focuses on are patterns, recurring shapes, and volume analysis. One of the first things Dux looks at when examining a stock is float rotation. What is this? Let's explain it simply. The number of publicly traded, buyable, and sellable shares of a company is called the float. Dux looks at this. Have all these shares changed hands within a single day? If a stock's daily volume is greater than the number of shares in circulation, float, there is an extraordinary situation there. Let's say the float is 1 million, but 2 million transactions happen that day. This means the owners of the stock have completely changed. There is a new cost basis, a new excitement, and probably a huge manipulation. This data forms the foundation of his strategies. Let's briefly look at his most well-known models. First, red day, perhaps the strategy most identified with Dux. Think of a pump stock. It has been rising for days. It has gained 100%, 200%, 300%. Everyone is talking about it on social media. The small investor is buying at the top. Dux waits patiently. He never tries to open a short sale at the top. What does he wait for? That first day when the stock's close is lower than the previous day's close. That is, the moment the trend breaks and fear begins. The first red day is the moment the party is over and everyone starts running for the exit. Bounce short. When a stock falls sharply, it usually makes a reaction rise we call a dead cat bounce. Novice investors start buying thinking, oh, the stock is turning, it will rise again. Dux knows this is a trap. He uses this bounce as an opportunity to open a short position at a better price. Morning panic dip. Buy. As soon as the market opens, panic selling occurs in some stocks. Stops explode, everyone sells in fear. The price falls way below where it should be, to an irrational place. Dux waits here like a hunter. He buys at that oversold point where the panic ends and the price finds support, catching the short-term reaction rise. And many more. Gap up short. First green day. There is one single thing common in all of them. Statistics. Dux doesn't say, I think this stock will fall. He says, when I look at 1,000 past examples, I know that this formation results in a decline with 75% probability. That is what makes the difference. One guesses, the other plays the probabilities. To wrap it up, my friends, the biggest lesson we need to take from Steven Dux's story and put in our pocket is this. Trading should not be an adventure where you seek excitement, but a boring job. Dux writes down his trades at the end of every day. He keeps his journal. Sometimes he doesn't trade at all for days. He looks at the screen and says, there is no opportunity fitting my system today, and turns off the computer. Because for him, money is earned not by trading, but by sitting in the right place, that is, with patience. The market changes, the names of the stocks change, technology changes. But human behavior, that is fear and greed, hasn't changed for 1,000 years and won't change. That's why the patterns Dux uses don't die, they just change shape. If you want to walk this path too, ask yourself this question. Am I playing according to my feelings like a gambler, or am I managing according to my data like an engineer? Steven Dux shows us that. There is no miracle in this business. There is no magic wand. There is only discipline, statistics, and patience like steel. I hope this episode gives you a different perspective when you sit in front of the screen. See you in the next episode. I wish you profitable and, most importantly, controlled days.